welcome to the Strategic Growth video podcast. This is Jim Denholm, founder and CEO of Ironbridge Private Wealth. Thank you for joining us today. Today we're going to talk about four primary topics: the housing market, the stock market, some of the similarities we're seeing with the stock market today versus 2008, look at the yield curve, and look at some updates with inflation and some of the commodity indicators there. So let's go ahead and get started. You know, volatility has been high all year, and when we look really big picture, we have clients asking us, what should we expect? What's the outlook look like? I think we need to look at housing. This is an interesting indicator. So if we look at the housing market right now, this blue line shows this. The blue line is the Case-Shiller Housing Price Index. We really haven't seen any deterioration in housing prices. There might be some pockets here and there across the U.S. that are seeing some softness in prices, but we haven't really seen much of that just yet. However, if we look at leading indicators of the housing market, two in particular, a change in the lending rate. So as of this particular chart, the blue line is a change in the lending rate plus the change in the month's supply of available houses for sale across the U.S. And as interest rates go up and as the lending rate, the 30-year mortgage goes up, this blue line will go down. As the month's supply goes up, that blue line goes down. And what we've seen is a pretty high correlation over time between the blue line and the dark blue line and the light blue line. And what we've tend to see is that the dark blue line, this regression of leading indicators, tends to lead. It led in the tech bubble. It was more coincident in 2008. Everything sort of collapsed at once, but there was a little bit more deterioration here in the leading indicator. It lagged going up, it led going down, led going up, led going down, led going up, kind of coincident going up, and now there's this massive disconnect. So on one hand, and this is going to be a theme with this discussion today, you can really look at things either way. On one hand, if we just look at this chart and take it on face value, we should expect a lot of volatility in the housing market. On the other hand, we can look at it and say, well, at this peak right here, we had record low mortgage rates in the history of time. We had record low inventory in the history of the U.S. And so, yeah, it can't stay up at that level. So we're almost getting back to more normalized levels. And maybe the price doesn't go down and follow this the light blue line, follow this dark blue line to that extreme. Maybe it starts to normalize somewhere in the middle. Either way, if we look at the housing market, it's 15% of U.S. GDP. More broadly, the consumer is 70% of U.S. GDP. If the housing market collapses, GDP will collapse. We will see an economic environment, maybe not to the extreme of 2008, but it will be very, very difficult if housing prices collapse. If they don't, if this was just a reversion back to a more normal environment, which you can easily make that argument, and housing prices maybe stay flat for a period of time, kind of like they did at some over kind of multiple years of flat, and it renormalizes itself, then maybe we have a mild recession. Maybe we just don't get any major growth, but we don't see any kind of collapse. I think how housing prices play out over the next few months, really 3 to 6 months, given the steepness of this decline, I think we're going to know which direction we're going to go. So let's watch the housing price, and this Case-Shiller Price Index is going to be very, very important to watch. Switching gears over to the S&P 500. This shows the S&P 500 over the last year. We saw a lot of volatility in the first half of the year. We saw a low in June so far of the bear market. and we saw this really massive increase, about a 16-17% rise of the S&P 500. I know we had some clients that were a little nervous because we were very heavy in cash. We didn't put a lot of allocation back into stocks. We were getting signals that it was most likely a bear market rally. There was not enough strength kind of early on to justify the kind of move that we saw. We started to see some better strength later on, but the market touched this 200-day moving average, which is something that a lot of market participants watch. It literally touched it almost to the point and sold off over 10% in just 2.5 weeks. So, almost 70% of the rally was kind of removed with this volatility down. We've started to see a spike higher. It's just the kind of volatility that we're seeing. So if we're under this 4,200 level, where we saw it kind of stop out in the first part, it kind of peaked above it here, and we're above this 3,700 or 3,800 level. We're kind of in no man's land here with no real direction. That's probably what we're going to be seeing. But it does look with this very quick retracement and this quick 10% decline, it looks like we probably just saw a bear market rally. A couple interesting charts, not going to spend a whole lot of time on it. We don't use this kind of stuff in our investment process, our allocation process, but it is pretty interesting to look at 2008, which is in yellow. This actually started on April 25th of 2006, was right here. And white is the current market environment starting a couple years ago. So the yellow line, if we look, these yellow and white line are really rhyming quite a bit. It's concerning that it is so highly correlated. Even a lot of these little wiggles are pretty correlated. It doesn't mean we should take any action. It doesn't necessarily mean we should short the market or, just move everything to cash and put it under a mattress. But it is something that we need to be aware of, that there is quite a bit of correlation to that 2008 environment. It's not just stocks. The VIX looks almost identical as well. The blue is the VIX through 2008, from 2006 to 2008. And the white is the current VIX. If we start to look over the last kind of 6 months when the volatility started, it correlates to about the first 6 months of the 2008 bear market. All of these little wiggles in the VIX are kind of rhyming pretty well. And what we saw in 2008 is volatility decreased in August and September of 2008. And then we got to late September and Lehman went bankrupt. And we saw this massive spike from 20 to 80 in just a couple weeks, 2 or 3 weeks. So we're not quite out of the woods yet. Either way, this may not even come to pass, but just something interesting to keep our eye on. Scenarios. This is probably the biggest question we get, what's going to happen. When we look at the scenarios, we don't know what the market's going to do. I wish we did, but these are just 3 of a million potential outcomes that could happen, but something that we need to watch. One would be, that we're going to head down pretty soon, that this rise from June to a few weeks ago was a bear market rally. We've seen a very sharp 10% move lower. We saw a little bounce, and we could start to see it deteriorate. This support area becomes very, very important. If we break down below that, a lot of bad scenarios open up. A second scenario would say we're not going to go down right now. Maybe this overall bear market rally has another leg higher to go where we don't get back up to the all-time highs. We might get within spitting distance of it. We might get within 5 or 7 or 8% of it, or less. But then we start to deteriorate kind of into Q4, kind of mid-late Q4, and then into Q1. This would be probably predicated on housing weakness really starting to show up in a few months. This would be predicated on, maybe Europe really going through some difficult economic times, maybe some geopolitical tension with China and Taiwan disrupting supply chains and potentially an additional war to deal with. Could be inflation spiking, could be a Fed misstep. There's a lot of things that could go wrong. but they might not. We're not seeing a deterioration in housing prices. Unemployment still looks good. Manufacturing is weak, but it's not terrible. So we could end up in this environment where, that we've had a lot of excesses over the last 14 years. We probably need more time than 6 months and 24% to work all those off. Maybe we go into this longer term choppy environment. Portfolios are going to look very different if one of these kind of really bearish scenario happens, or if a more bullish or just kind of a sideways choppy pattern happen. In this down environment, we want to be very heavy in cash. You simply want to get out of the way. You want to be positioned to take advantage of prices when they complete a bear market. In the choppy market, it's much different. You really want to focus on yield. In this kind of environment, the likelihood, if we get through the next 3 to 6 months and we don't see some of these, more negative scenarios start to play out, the risk of a big decline really gets reduced dramatically. So we can start to own some things that have higher yields, whether it's more dividend-paying stocks, some floating rate instruments, some public and private real estate of various sorts, some different kind of structured bond investments that can give us, 3, 4, 5, 6, 7% yields. And we start to really focus on clip and coupons with a small tactical portion in your portfolio. So I think we're going to see this. I think we're going to know in the next few months. I don't think we're going to have to wait a year or two to know the outcome of this. Just the way that everything is lining up right now, I think we're going to know before the end of the year or early next year how this is going to play out. Yield curve, real quick. This is the yield curve. This is the Treasury yield curve. The highest point is at 1 year. This means that if you buy a 1-year Treasury, you get 3.6%. If you buy a 10-year Treasury, you get under 3.3%. So you get lower interest if you go longer duration. That's the inversion. The shorter is paying higher than the longer. This has been the best recession indicator in the history, or at least in the last 100 years. So it's telling us that we should expect a recession. It typically starts within 6 to 18 months of the initial inversion. We're about 6 months into an inverted yield curve right now, so we probably have now for another 12 months to really know that we're in a recession or get into a recession. Again, I don't think we're going to have to wait a real long time to know the direction of this market. One good thing, inflation should start falling, whether this is just supply chains getting back up, whether it's the Fed, whether it's economic slowdown. But the first half of the year, there were massive commodity spikes. Oil, copper, lumber had huge spikes. Over the last kind of 4 or 5 months, we're seeing copper down 24%, oil down 27%, lumber down 61%. Commodities are falling in price. That's going to start making its way through the CPI numbers. So it looks like the inflationary pressures are really starting to fall, which should be a good sign for the markets and for the economy, unless it's demand driven. So in summary, risks do remain very high right now. We should expect volatility to continue. We really need to keep emotions in check, not get too fearful when the market's going down, not get too regretful if we don't participate in every percentage higher. We think we should expect volatility to continue. The outlook is still very unclear. We could make very logical arguments for an incredibly negative environment. We could make very logical arguments for a choppy or slightly positive environment. And bottom line, we think that we're going to know that answer pretty quickly. I don't think we're going to have to wait a year. I think within the next few months, give or take, we're going to kind of know the direction of what the market wants to do. So Thank you. If you'd like some more information, we post everything on our website, ironbridge360.com. Feel free to reach out to me directly, jim.denholm@ironbridge360.com. And I do post on Twitter @denholm_Jim. So thank you for joining us today, and invest wisely.